Hi folks, you're with Tacitus today at your Pushback channel, and thank you for joining this audio no pictures live stream. Please listen to this presentation as you would a radio broadcast as you're driving along in your car, your truck, or going along in public transport. In this essay, I'd like to talk about this supposed stock market declines, crashes, corrections, call it what you like. The decline in the stock market over the last week or so has been, depending on which index you're looking at, between sort of 3 and 5%. But that's viewed as a disaster. The screaming headlines of 100 trillion billion gazillion wiped off stock market devastation. That's all bullshit. That's just ridiculous hyperbole. Well, we need to sort of look at in a little bit of a wider context. So I'll talk about that. Over the last 5 years, the stock market, and this I'm looking at, say, the S&P index, that sort of thing. The stock market has close on doubled in price. Now, it hasn't gone up at all in terms of intrinsic value. In fact, intrinsic value has declined over the same time as the prices have gone up. And I'll come back to that explanation in a minute. Now, if we go at slightly longer times, 10 to 12 years, the price of the prices in the stock market have almost tripled. Again, as intrinsic value has declined. So I'll just sort of try and give you a simple explanation to intrinsic value. So you're selling your used car. You want to sell a used car. And the realistic price of the car is I'll use round numbers to be simple here, is $100. But you want to sell the car for $500 or $1,000, $10,000. The intrinsic value of the car hasn't changed. It's still $100. The fact that you want to sell it for $10,000 doesn't change the intrinsic value of the car, so the vehicle. But if you can get $10,000 for it, hey, good, well done. But if you put $10,000 in the price, so you got like your advertising or something, got $10,000, that doesn't mean the car's worth $10,000. That means you want to sell it for $10,000. But suppose you get together with a bunch of people and a bunch of your buddies, and you all have these overpriced cars that you've priced at $10,000, and you sell it back and forth between each other in like a round robin thing. You buy his car, he buys your car, and this and that. So you could create this illusion that these cars are all worth $10,000. Well, someone paid $10,000, the guy, but it's a fixed and a rigged pricing, so that the car is still worth $100. And declining in value as time goes on. So the rigged $10,000 price is a reflection of how it's been rigged and ginned up, not a reflection of intrinsic value. So anyway, I'll come back to that again and explain a bit more. So real estate over the same time, if we look at say, in some cases, especially since the dot-com crash occurred in like 2001, the stock market's gone up by 400 or 500% since that bottoming out there. Now, real estate has been something similar. A house that you could buy for $400,000 in 2001 can sell for $2.5 million today. 5-6 times the price that it was 25 years ago. Now, there's been a few reasons for this. One is that interest rates, in order to stimulate economic activity, interest rates declined, were brought down to effective zero. So when you can get a return on investment, say with savings and the more traditional type of income producing ways of investing capital, you get an interest rate return, that sort of thing there. Then because interest rates were zero, you couldn't get a return on savings. So capital was sort of sitting there all lazy, nowhere to go. And so investing it in the stock market or investing it in real estate became the way to make a return on your capital. And so this was a very artificial moving of capital into those two investment classes, shares and real estate. And this created an artificial boom in turn. Now, at that time, in order to keep the boom under control, what should have happened is that the bank should have demanded a high or required a higher deposit, so that people wouldn't go into real estate highly geared in a zero interest rate environment. Same for shares, that you shouldn't have your gearing ratio should be 1-3 or 1-4 or something like that. So every dollar you borrow to buy shares, you have to have $4 in real money, these sorts of things. But instead, the gearing was allowed to go sort of uncontrolled, so people effectively could borrow 100% of the money to buy real estate, or close to that to buy shares. Not in all classes, by the way, but not in all classes of shares. But this created an artificial boom, not in value or related to intrinsic value. Now, shares were real estate meant to represent the purchasing power of the local population. The local population purchasing power, can only afford to pay X amount, then that's approximately the price of real estate. And that ratio has stayed pretty much constant throughout history of real estate owning. But it decoupled sort of hugely I suppose you could say starting in the later 90s, in particular the late 90s, and going on from there, so that the purchasing power of the people buying the local population, buying real estate, started to have no relationship to the actual price of real estate. And this decoupling is quite unique in history. Now, there are various reasons for that. It's not just simply low interest rates. It's the higher gearing, overseas purchasing of real estate, which is huge, certainly in Australia and the West. All these things sort of conspired and contributed to higher real estate prices. Also, treating real estate as a class of investment rather than a place to live, and this too was part of the problem with overpricing. And so the intrinsic value of residential real estate is the purchasing power of the local population. That's the intrinsic value of real estate. So real estate has gone probably 60%. So if you're looking at for example, $100,000 property, its real intrinsic value price is closer to $40,000 to $45,000. That's the extent of overpricing that's occurred. Now it needs to correct. Now, whether that correction is managed over time, whether it's a crash or whether it's happens fairly quickly or slowly, that really doesn't matter. But that rebalancing will need to take place at some time, and that massive difference of intrinsic value of residential real estate to the actual price that they're selling for at the moment, that differential between intrinsic value and the price, that's the extent of the correction. Now, the same goes for shares. The intrinsic value of shares, there's a certain ratio of value relation to share, the profitability of the company and this sort of thing. That creates a model for intrinsic value. Now, the shares at the moment are share price in the stock market, not simply in the United States, but elsewhere around the West. The shares are again between 60 and 75% overvalued. Now, it's not exactly the same in every single category there, but that's the reality, that the share market is horrendously overpriced. We also need to there's a few things there. Instead of when share prices were originally conceived, they were conceived as moms and pops and people, private citizens owning their little handful, their lots of 100 shares or something like that, 200 shares, whatever. And that was how it was perceived, or community groups getting together to buy shares. That's now changed. You've got the State Streets, the BlackRocks. You've got the top four companies that control vast amounts of the activity on the stock market, and they form wolf packs. So coming back to the the analogy of the $100 car selling for 10,000, because you get a group of guys all selling the car for $10,000 back and forth between each other to artificially create the illusion that the car actually has a value of $10,000 when really it's $100. That's what's happening in the share market. You've got this wolf pack of big players that all sell the shares back and forth to each other, and the participation of the small players is minuscule, and so these bigger players are able to walk up the price of all the shares, certainly the key index shares, just walk up the price because they sell back and forth to each other, and they just walk these prices up to whatever level they want, and so they create this artificial value that has no relation to intrinsic value. Now, intrinsic value is meant to be, again, the profitability of the company and this sort of thing, of the share price. It could be anything, a consumer goods like, I don't know, Coca-Cola or something. It could be anything, but that's changed now, so that profitability can decline, and so the actual value, the intrinsic value of the shares, can go down at the same time as the big wolf pack, the BlackRocks of the guys are walking the share price upwards while the intrinsic value is actually declining. So the gap between intrinsic value and the share price and the actual share price was widening. So that gap was widening, particularly over the last 5 years, but even over the last sort of 15 years. And this has really changed the whole nature of the stock market. Similarly, the boards of directors of most of these companies are the nominees of the State Streets and the BlackRock. They're their buddies and their flunkies and their stooges, and they've got because they've got such tremendous control over the stock price, the share price. They can go to CEOs. I've mentioned this in other videos. They can go to CEOs saying, "Look, well, we're going to set your $10 million bonus or $20 million bonus this year to if the share price reaches $50 a share." Now, in a market driven, that is the intrinsic value, lots and lots of small buyers all deciding what the value of the share is, and they want to buy them, then that situation works. But here, all these wolf pack guys need to do is get together, just walk the price up to $50. Bingo, that gets the $10 million, $20 million bonus to the CEO. Now, for that sort of money, the CEO will do whatever he's told. We want you to appoint black lesbians to the board. Done, agreed, it'll happen. If I get my $20 million bonus, you could appoint Mickey Mouse to the board. I don't give a shit. I get my $20 million. I don't have to worry about and so on. So this introduces a level of control and corruption. Whether you want to call it corruption of purpose or financial or corruption of intent, it doesn't really matter, but it creates or has this effect. Whether that's the actual basic purpose of it all is another matter, but it has this effect. And it also creates the interactive architecture between the big fund and the management of the company. It creates this interaction that lends itself so easily to corruption, and that maybe is the bigger issue here. So this is what's been going on now. On top of this, if you look at the increase in share price, which is historically very high, you don't get these sorts of increases in pricing of shares or for that matter real estate, unless the functioning of the market is corrupted and undermined and subverted. A properly functioning market won't do this. It can't get too far ahead of intrinsic value, and very rarely does in a functioning market. But this is not a functioning market of buy, sell, supply, demand, and value, and none of these things are applying. Now you can get sort of a periods of hysteria, usually very brief, that do correct fairly quickly, but this is something different again. So the amount of shares being purchased in the share market has been declining. So fewer people buying, fewer shares being traded, reduced share activity, and while prices are going up. So wait a minute, stop. You say, you mean fewer people are buying less and less shares while prices are going up and up. So clearly that that's an example of the market not functioning. And the way prices go up is more people want to buy them. So the sellers are overwhelmed, if you like, and prices go up because people are charging in to buy the shares. That's not what's happened in this share increase. The big funds own so much, and they round robin the shares back and forth between each other, and that's what's walking the price up, and that's why share trading is going down, because there's no other players coming in, and these guys can walk the price up. So even if share prices were to decline by 50%, it would still be an overvalued share market. If real estate prices, as in residential real estate, were to a large extent office real estate, were to decrease by 50%, that too would still be overpriced at that. So now, how and in what way and over what time frame these overpriced situations will correct, that's yet to be determined, and that's the exposure. Does it happen quickly, slowly, and so on? I prefer a sort of managed decline, because the shock of so many overgeared people, people who borrowed shitloads of money to play in these, that we don't want them being wiped out. The knock-on effects would be too negative, but should a gradual sort of increase. If you want to buy real estate, you've got to have a bigger deposit. That should be the case, and that will manage house prices down to a point where it once again meets the purchasing power of the local population. But there's other factors in play, such as the World Economic Forum. The future they have mapped out for us is you'll own nothing, and everything will be owned by the BlackRocks of the world, and you'll simply rent it from them or borrow it from them in return for, like they're the feudal lord of the medieval era, and you have to tend to their fields, their crops 2 days a week in return for they let you live in some shitbox place. I saw a thing from London, a 1950s TV show where two people working full time in an okay sort of job, in a public service, and they were living in London, and they had this tiny bedsit apartment where the lounge room and the bedroom was sort of one room, and a tiny kitchenette and a tiny bathroom, and that was the apartment. It was minuscule, and that was two wage earners, in their mid to late 20s, living there. Goodness me, how times have changed. You've been with Tacitus today, your Pushback channel, and thank you for listening.